All right, well, hello everyone. In this particular recording, we're going to go through our homework for colleges and universities. Nope, actually, check that. We're going to go through our homework for healthcare organizations. So, healthcare organizations, the reason why I was a little distracted with colleges and universities there a few seconds ago was because of this. Healthcare organizations are accounted for extremely similar to colleges and universities. We've got private colleges and universities. We've got private healthcare organizations. We have public universities. We have public healthcare organizations. And revenue is recorded at the gross amount, regardless if the patient pays or not. Just like with colleges and universities, tuition revenue is recorded at gross amount, regardless if the students wind up paying all of it or not. So, very similar setup. I'm going to go through one homework problem dealing with a private hospital, private nonprofit facility, and then we're going to go through one where it's a public nonprofit university, and lastly, a side-by-side comparison. All right, so let's take a look at these journal entries. Number one, the hospital has a contractual agreement with a lender requiring that $500,000 in cash be set aside to meet its future debt payment. So basically what's happening is we signed a contract, the hospital signed a contract, and in that contract the lender is saying, hey, you have to keep $500,000 aside at all times. All right, we're going to record that in something similar to a restricted cash account, and we're going to call that assets limited as to use. This is very similar in a credit cash, of course, because the cash count is going down, and we're going to put it in this assets limited as to use. Now, the reason we do this is because we want to keep it on a separate line item in the balance sheet. This is very similar to a private nonprofit's use, a public nonprofit's use of restricted cash that we learned in an earlier chapter. All right, number two, the hospital accrued $1.5 million in patient service revenue. Charity services of $415,000 were also provided. Contractual adjustments total $535,000. So basically what is going on here is the hospital is going to record their revenue at gross amount, which is $1.5 million. Now, if you recall, charity service means that the hospital has provided services to patients that have a demonstrated inability to pay. Those would be like the example I like to give is the homeless person going into the emergency room at 3 a.m. and they needed immediate medical help. Well, they're not going to get turned away just because they don't have any money. They are going to be We're going to be able to, the hospital are going to be able to provide them service. However, the difference is because they have a demonstrated inability to pay, that doesn't get recorded as a revenue at all. That is the one exception. Now, a contractual adjustment. A contractual adjustment is the difference between the gross pay, the gross revenue, and the amounts that the insurance companies have agreed to pay for that particular service. The difference between the two is going to be recorded in a contra revenue account, and we're going to call that contractual adjustments. This is very similar to a university forgoing tuition for a scholastic waiver. We use a contra revenue for that as well. Number three, an increase of $45,000 was recorded for bad debts. We will debit provision for bad debts, which is a contra revenue account, and credit your contra receivable, your allowance for doubtful accounts. Number four, general services of $100,000 were donated by technicians. Normally, the hospital would have purchased these specialized services. So, as we learned in an earlier chapter, when a private nonprofit, and this is a private nonprofit hospital facility, when they receive donated services that have come with a specialized skill that normally would have been purchased, we're going to record that as a contribution. Debit general service expense, because it was a service, that was incurred right away, and the credit goes to contributions without donor restrictions. Number 5, an endowment contribution of $1.5 million was received. And debit cash, and remember, an endowment means a permanent contribution that can never be spent, so it's a contribution with a donor restriction. Number 6, investments held by the hospital increased in fair value by $32,000. Debit investments and credit unrealized gain for the change in the fair value for $32,000. Okay, number 7, the hospital purchased $837,000 in equipment with resources that have been contributed in prior years for such a purpose. So basically what we're saying is contributions that were restricted in the past have now been used and the restriction has been met. So what we're going to do is really a two-step process. First, we're going to record the purchase of equipment by debiting equipment, crediting cash. In addition, that $837,000 was released. So we will debit net assets released dash with donor restrictions to decrease it, and we will credit net assets released without donor restrictions to increase that column. So these are private, non-for-profit hospital. Okay, and the next problems deal with the same journal entries, but the hospital is no longer a private nonprofit hospital, but it is a government, public nonprofit, right? Owned by the government. So there are a couple of differences. The first one is really, and the first one with, instead of using assets limited as to use, you would use this restricted cash account. It's just really a naming difference, not that big of a deal. Journal entry 2 is accounted for in the same way. Revenue recorded at gross. Charity services not recorded at all. And the contractual adjustments recorded as a contra revenue account. Journal entry 3 is the same. Journal entry 4 is different. If you remember, 4 is when we had services donated to us. Well, the public nonprofits don't recognize donated services at all. It doesn't matter whether it's a specialized skill or not. Big difference. Journal entry 5 is the same. We just remember we don't need to keep track of contributions as either with or without donor restrictions. That's the difference there. And of course, we don't need to release restrictions in number 7. Great homework problem. Shows them side by side what the changes are, what the differences are. Really like this homework example. Shows you side by side what's going on. All right, now let's take a look at a private nonprofit hospital. More of the same. We just keep practicing, okay? Number 1, services provided to patients amounted to $9.6 million. Now, out of that amount, $450 was for charity care. And remember, as we just said, with charity care, that does not get recognized at all as a revenue or a receivable or a write-off. None of it. So 9.6 minus the 450, $9,150,000 we're going to credit to the revenue account. $928,000 was paid by uninsured patients, so we received cash, debit cash of $928,000, and the rest was billed to Medicare, Medicaid, and insurance companies. We will debit the receivable for that. Number 2, donated pharmaceuticals and medical supplies valued at $265,000 were received and utilized right away. So donated assets are recorded at fair market value at the date of donation. So we will debit general expenses because we used them up right away. If not, we would have just debited the asset account. And we're going to credit contributions without donor restrictions for the $265,000. All right, number 3. All of those Medicare, Medicaid, and insurance companies, they approved and paid, out of the $8,222,000 that were billed to them in journal entry 1, only $5,365,000 was paid. The rest is a contractual write-off, a contractual adjustment. So we're going to credit the receivable for the full $8,222,000. It goes away. but we're only receiving $5,365,000 in cash, debit to cash. The other $2,857,000, that is a contra revenue. It's the difference between the gross revenue and the amount the insurance companies have agreed to pay. Big difference there. Number 4, an unconditional contribution. So that's important, that word unconditional. That means we can record it. Of $5 million was received in cash from a donor, and the donor stipulated, so the donor had a restriction, to construct a new facility for care of patients. The full amount is expendable for that purpose. No activity occurred for the current year. So that $5 million, debit cash, and we're going to credit contributions with a donor restriction. It is a use restriction. And number 5, a total of $965 was received from auxiliary resource or auxiliary revenues. Cafeteria, the gift shop, medical seminars, transfers from the foundation, fees from medical transcripts. These are all revenues above and beyond just your medical patient service revenue. All right, hospitals do other things, cafeterias, gift shops, etc. So that is a debit to cash and a credit to the various other revenue accounts. And last but not least, number 6, uncollectible accounts totaling $3,250 were written off, and then new allowance for uncollectible was increased by $1,170. So 2 things. First, the write-off, debit the allowance for doubtful accounts, credit the receivable, and the new provision for bad debts. Remember, that's a contra revenue account, and credit the contra receivable. All right, so that's what we see here in a private, nonprofit healthcare organization. And last but not least, let's take a look at a public-run hospital. This is a public, Milos County Hospital. More of the same. It's just getting used to the journal entries. Gross charges, $1,664,900. Debit receivable, credit revenue for the gross amount. We haven't done any analysis yet of what that needs to be contractually written off, but we will get to it really soon. Number 2, the hospital, cafeteria, and gift shop. Sales of $295,300. Cash sales. Debit cash, credit all the other revenue accounts. Okay, number 3, additional information. So that $1,664,000 that we recorded as revenue, we did some more analysis, and we concluded that $632,000 is a contractual write-off. $261,000 of it is charity care, and we shouldn't have recorded as revenue to begin with, and $30,200 doubtful that it's going to be collected. So we have to increase our allowance for doubtful accounts. Journal entry, first, debit contractual adjustments, that's the contra revenue. Debit your provision for bad debts, also a contra revenue. And we will reduce patient revenue directly. This would have been for the charity care that we should not have recorded revenue to begin with. We will credit the allowance for doubtful accounts for the $30,200, and the other $890,000 basically should have written off. We shouldn't have recorded the charity care or the contractual write-offs as receivables to begin with. So that's a write-down of the receivable directly. Number 4, a federal cost reimbursement research grant of $350 was awarded. As of the end of the year, $200 in expenses related to the grant have been made. All right, so since it is a public public healthcare organization, we cannot record revenue until we actually do the work that's covered underneath the grant, which is very different than a private. Private, we'd be able to record the full $350 as a contribution up front. But here we don't. 2-step process. First, we're going to debit the research expense and credit cash for the $200,000, and only the $200,000, not the full $350. Only the $200,000 is recorded as a revenue. Debit cash, credit revenue. All right, number 5. Basically, we vouchered a whole bunch of expenses for payment. Some of it is inventory, which is an asset, and some of it is accrued as of the end of the year, or I should say accrued previously, and now it's vouchered for payment. So we're going to debit all of our expense accounts, debit inventory, debit our liability accrued expenses, and it's all vouchered. And what this word vouchered means basically is approved for payment. So we will credit the liability vouchers payable. And we'll be ready to pay that off really soon here. Number 6, collections of receivables, $1,159,000, and some other receivables were written off, $11,900. The sum of those two, $1,170,000, will credit the receivable. The vast majority of it was collected, so we'll debit cash, and the other amount we're writing off, so we will reduce the allowance for doubtful accounts with a debit. Number 7, we're paying off some of our accounts payable, $1,031,000. Real simple, debit the payable, credit cash. Very simple accrual-based journal entries. Number 8, supplies of $99,000 were issued to nursing services. And when they were issued, they were used right away. $99,000. So we basically have an expense at this point. Debit the expense and credit the supplies inventory account. And number 9, December 31st, accrued interest income, $800. Debit interest receivable, credit interest revenue. And lastly, number 10 is the depreciation on the fixed assets for the fiscal year. Debit depreciation expense, credit accumulated depreciation. All right, so if we take a look, those are all of the journal entries for the year. And what we're going to do is at the end of the year, we have to go through the closing entry. So we will close all of our revenues with debits. We will close all of our expenses and our contra revenues. We will close them with credits. And everything is going to get closed out to unrestricted. Now, if we have any restricted or net investment in capital assets, we would update that at this time. All right, but I didn't read anything about that in this particular. And then, of course, your statement, your operating statement, we're going to show the gross revenue less the two contra revenue accounts, the contractual adjustments, and your provision for bad debts.